Hi, today I'll be discussing the Federal Reserve System. The United States banking system is quite complex and involves several parts working together to ensure the stability of the economy. One of those key resources is the Federal Reserve System. What is the Federal Reserve System? The Federal Reserve System, per definition, is a U.S. banking system that is under control of a central board of governors, i.e. the Federal Reserve Board, with a central bank, i.e. the Federal Reserve Bank, in each of the 12 districts, and that have a wide power in controlling credit and the flow of money, as well as in performing other functions as regulating and supervising its member banks. During the 19th century, the beginning of the 20th century, financial panics plagued the United States, leading to bank failures and business bankruptcies that severely disrupted the economy. The failure of the nation's banking system to effectively provide funding to troubled depository institutions contributed significantly to the economy's vulnerability to financial panics. Short-term credit is an important source of liquidity for banks experiencing unexpected and widespread withdrawals during a financial panic. Banks during this period experienced what is known as bank runs, which is when most of the bank's depositors withdraw their money and the bank does not have enough cash to meet the deposit. After several banking panics, Congress passed the Federal Reserve Act to provide the establishment of the Federal Reserve Banks to furnish an elastic currency to afford means of discounting commercial paper to establish a more effective supervision of banking in the United States and for other purposes. President Woodrow Wilson signed an act into law on December 23, 1913. Originally, the Federal Reserve was instituted to provide lending during poor economic times, but over the years, Congress has broadened the role of the Federal Reserve through legislation. Today, the Federal Reserve duties fall into four general areas: conducting the nation's monetary policy by influencing the monetary and credit conditions in the economy in a pursuit of maximum employment, stable prices, and moderate long-term interest rates, supervising and regulating banking institutions to ensure the safety and soundness of the nation's banking and financial system, and to protect the credit rights of consumers, maintaining the stability of the financial system and containing systematic risks that may arise in the financial markets, and providing financial services to depository institutions, the United States, and the foreign official institutions, including playing a major role in operating the nation's payment systems. Congress designed the structure of the Federal Reserve System to give it a broad perspective on the economy and the economic activity in all parts of the nation. It is a federal system composed of a central governmental agency, the Board of Governors in Washington, D.C., and 12 regional Federal Reserve Banks. The Board of Reserve Banks share responsibilities in supervising and regulating certain financial institutions and activities, for providing banking services to depository institutions and the federal government, and for ensuring that the consumers receive adequate information and fair treatment in their business within the banking system. A major component of the system is the Federal Open Market Committee, or FOMC, which is made up of the members of the Board of Governors, the President of the Federal Reserve Bank of New York, and the President of the 4 other Federal Reserve Banks. We also serve on a rotating basis. The FOMC oversees open market operations, which is the main tool used by the Federal Reserve to influence overall monetary and credit conditions. The Federal Reserve implements monetary policy through its controls over the federal fund rate, the rate which depositories institutions trade balances at the Federal Reserve. It exercises this control by influencing the demand for and the supply of these balances through the means a network of 12 Federal Reserve banks in the branches. Carries out a variety of system functions, including operating a nationwide payment system, distributing the nation's currency and coin, supervising and regulating member banks and bank holding companies, and serving as bankers for the United States Treasury. The United States, or the 12 reserve banks that are each responsible for a particular geographic area and district in the United States. Each reserve district is identified by a number and letter. Besides carrying out functions for the system as a whole, such as administrating nationwide banking and credit policies, each reserve bank acts as a depository for the banks in its own district and fulfills the district responsibilities. The Board of Governors of the Federal Reserve System is a federal government agency. The board is composed of 7 members who are appointed by the President of the United States and confirmed by the United States Senate. The full term of the board members is 14 years, and the appointments are staggered so that one term expires on January 31st of each even number year. After serving a full term, a board member may not be reappointed. If a member leaves the board before his or his term expires, however, the person appointed and confirmed to serve the remainder of the term may later be reappointed for a full term. The chairman and vice chairman of the board is also appointed by the president and confirmed by the Senate. The nominees to these posts must already be members of the board and must simultaneously be appointed to the board. The terms for the position are 4 years. The staff in Washington, D.C., numbering to about 1,800 as of 2004. The board responsibilities require thorough analysis of domestic and international financial and economic development. The board carries out responsibilities in conjunction with the components of the first Federal Reserve Board, which was established in 1914 with the Federal Reserve System. The Board of Governors also supervises and regulates the operation of the Federal Reserve Bank, exercises responsibilities in the nation's payment system, and administers most of the nation's law regarding consumer credit protection. Policies regarding open market operation established by the FOMC. However, the Board of Governors has sole authority over changes in the reserve requirements and must approve any change at the discount initiated by the Federal Reserve Bank. The chairman of the Board of Governors of the Federal Reserve System is the very, very top of the Federal Reserve System. The chairman directs monetary policy and determines the course of the Federal Reserve activities. When the chairman speaks, business leaders and politicians in public take notice. The chairman is appointed for a 4-year term by the president, subject to confirmation by the Senate. However, unlike other presidential appointees, such as the Secretary of State and Secretary of Defense, the federal chairman is usually selected for its effective stewardship of the economy as for political philosophy. When the Federal Reserve System was created in 1913, the chairman had a little more than a figurehead, the guy with a gavel who presented over the board meetings. His actual power resisted with the power of the president of the United States. Excuse me. The actual power rested with the power of the president of the New York Federal Reserve Bank. However, due to a large part of the restructuring during the Great Depression of the 1930s, the chairman is now one of the most powerful economic decisions in the United States and even the world. The chairman usually sets the course of monetary policy and banking regulation. The wishes and policies of the chairman need not to be approved by the rest of the board, but they typically are. In addition to being an administrative head of the entire Federal Reserve System, Discount window lending. Extensions of credit to depository institutions made through the primary, secondary, and CECL lending programs.